Well, good afternoon, everyone, and welcome to our 2023 second quarter market update and outlook webinar. Where the first half of the year flew by. I think most people feel that way. And then now we're starting off the second half of 2023. Let's see. As we get started here, we'll just I think we looked at the poll questions, the poll question that came up, and if we see the results, but anyway, okay. Well, my name is Dana Vosberg. I'm the Managing Director of Advisory Services here at Manning & Napier. I'm happy to be joined by Chris Petrosino, Managing Director of our Investment Policy Group. Chris and the team are responsible for setting the firm's overview on our broad macroeconomic outlook, as well as on the financial markets, both with equities and fixed income, home and abroad, and on asset allocation decision-making. I'm also joined by Susan Pilon, a senior financial consultant in our wealth management group, covering the Tampa-St. Pete, Florida region. Susan has over 20 years of experience in the financial services industry, providing planning strategies and investment solutions across a full array of client needs. So thank you, Susan and Chris, for taking part in, sorry, we're trying to get control of the slides here, apologize. But thank you, Susan and Chris, for taking part in the webinar today.
Glad to be here.
Absolutely. Afternoon, everyone.
So as we get started, it'd be great to know really where everyone is joining from today. So please feel free to type in your location in the chat section. It's always interesting to know where people may be tuning in from, so to speak, and who we're reaching. Let's see, Denver and Ohio coming in. All right, so St. Pete, Boston, yeah, California. All right. Well, also we encourage questions. So if you have any questions at any time, please submit them using the Q&A function located at the bottom of the screen, and we'll spend time at the end of the webinar answering as many questions as we can, and while also being respectful of everyone's time. All right, so we have a lot of really good information to cover today. Our goal is to hit on a wide range of topics that people may be thinking about currently. And as usual, we'll provide our outlook for the U.S. economy and what we're seeing in equity and fixed income markets, as well as important financial planning considerations that go along with that. But I think it's important to focus on really two main takeaways from this webinar. One is really the need to really prioritize your plan. If you follow the financial news a fair amount, or even if you just catch up every so often, it can really be overwhelming to determine a good course of action when facing the uncertainty or challenges we see in the market. That's why taking time to review your personal plan can provide very helpful context and also make it easier to put actionable items in place. The market and the economic data that we're going to cover, it can impact people differently, and the planning strategies we mentioned may not be relevant for everyone. They can be, good tips and very helpful, but not necessarily going to have the same impact for everyone. So that's why the planning process is so important. The other takeaway is really the importance of risk management, and there's really a lot of potholes in the road of investing, to use that metaphor, and sort of managing your wealth. So as Chris summarizes certain characteristics that we're seeing and how we're positioning portfolios, our responsibility to our clients is to really navigate the risks and make the ride as smooth as possible while helping our clients achieve their goals. So I guess with that, excuse me, Susan, we'll start with you. As we've been meeting with clients this year, as you've had your meetings with clients, how have you been framing these big picture concepts and considerations for clients coming out of a challenging year last year and now halfway through this year?
Thanks, Dana. That's really a great setup, because we certainly have had last year was a challenge, right? We all went through that together. It was rough. It wasn't fun. And the markets recovered quite a bit this year. And so a lot of the things I've been talking with clients about is perspective, right? We tend to have a recency bias. It's a human nature for us to have that. And so one thing that we've noticed is, the market's been going up. Does that mean it's just going to continue going up? So we want to think about perspective, and we're going to look at a different time frame here. So I'm going to put up this first chart of time, and we're going to look at a couple of periods of time starting at the same starting point. So if we'll move forward on this slide, and we're going to see this is a patch of the market at some other time. So now we have a choice for you all, a poll to make. What year do you think this is from? And through a couple of these, you're going to get to continue to vote. So is this 2000, 2009, 2016, or 2020? And the reason we look at this 2 months of the S&P 500 is to remember that when we're going through these times, that feels very rough. That's a relatively short period of time in the market, 2 months. So let's go to the next slide. What happens 6 months into this time frame? So again, you can continue to vote on the poll and let us know what time frame you think this is. So we had that first 2 months, and now we're 6 months from that same starting point in the market. And clearly the market had a recovery. We had this downturn that felt very rough. We had this recovery, which felt a lot better, but 6 months is still pretty short. So let's look at a year time frame. All right, and here's a year. And as you see, as we start to pull back that lens, the market going up and down, it doesn't go straight up. We have pullbacks along the way. And it's to remember that in those times, even though the market's been up the past several days for a while, although the NASDAQ was down slightly today, and the S&P like flat basically, and the Dow was up. So, but we have these times where, the market's going down or the market's going up, or it's zigging and zagging along the way. And as we pull back the lens and look at a little bit longer time frame, it doesn't have, this is from 2 months to a year, but now let's close the poll out and make sure everybody has told us how long they think this is, what our time frames were, because, okay, most people, about 50% guessed 2009, and you are correct. So that green line that we're looking at, that is going to be 5 years in, and then the dark green line is 14 and a half years. So goes through 2023, so beginning in January of 2009, all the way through 6/30 of 2023. And as we look at this and pull back, we really see what a difference we see in the market. And there's always going to be those times that go down. Even though we've had this upswing recently, we want you to know volatility does come back in, and want you to think about that and be prepared for that. So we can't control the markets, but there are some things that you can control. And so on this next slide, we're going to talk about those. So you can control the strategy you're in. And Manning and Napier, we have had a long-term strategy that's been going on for over 50 years and has had successful investment outcomes throughout that. And we think right now, with the environment that we're in, that Chris is going to tell you lots about in a bit, active management is more key than ever. Other things that you can control is your plan and the things that are most important to you. What are those goals that you really want to focus on and articulate? And we'll talk about that in a moment, and how much more important it is to focus on that than it is on those short-term market returns that are happening. And then tax efficiency. Last year, for the first time in quite some time, we were able to do some things like tax loss harvesting and other strategies that are able to help us as we go forward and look forward. And speaking of looking forward, estate planning is something else. With rising interest rate, there's some new strategies or some old strategies that we can re-employ, and we want to consider those. And then the last thing that you can control is your mindset. And not having that short-term mindset. I know that can be very hard, especially if you turn on the TV and you're hearing the bad news of the day every other moment. So that's something that, that noise and that chatter is always out there. But we've heard a lot of things recently, and you've probably been hearing things if you've had the TV on or been reading the news or the financial news. And that's, everybody was on board that we were going to have a recession. And then some people said, oh, no, we're not having a recession. That's not happening at all. And some of those same people came back and said, oh, yeah, we're having a recession again. And then I heard somebody the other day say, we're actually going to have rolling recessions, and different areas of the economy are going to get hit at different times. So Chris, let's bring you in for some expertise on this. And if you would tell us, what does all that mean and what is our outlook?
Certainly. So I think recession, no recession, soft landing, a rolling recession, all these different ways that we can classify or describe the economic environment. I think what really matters is what is the risk, particularly we think about the investments that we make, what is the risk to earnings and profitability for businesses? So, full disclosure, our base case is that we are more likely than not to have a recession of some degree here in the U.S. in the coming quarters. But I think more importantly is we think about what are the risks, what are the likelihood, and as we've gone over things through the past several months and quarters, some of the signals and things that we'll go through, and we'll cover some of them today, we think that the risks are building, and this is an environment where, while things have been good, well, there've been relatively few bumps in the road, not much in terms of that volatility that you just walked us through. Now is a good time to start to think about both how portfolios are positioned, as well as from a planning perspective, that I'm sure you and Dana will touch on as well as we go out. But just making sure that we are investing in light of the risks that we're seeing in the economy today. So why don't we start with just a chart that we've used a few times over these past few webinars that I've been fortunate to be a part of, and this just looks at the year-over-year change in the index of leading economic indicators. So this is built off of 10 sort of forward-looking measures taken from both the financial markets as well as the real economy. And what it's done is it's rolled up into an aggregate index that's intended to give a sense for where things are going. So typically, when the index is in negative territory, that is a sign of slowing growth. When it's positive in booming, as that would imply good things on the horizon for the economy. And today we are sharply negative, down 7+% on a year-over-year basis. And when we look back historically, this is levels that isn't sometimes associated with recession, but rather every time associated with recession. So I think this is a good indicator to sort of keep front of mind and really lead things off with here.
Yeah, and Chris, maybe a question that some people are asking is, what makes up the leading index?
Certainly. So on the sort of financial market side, there's three main drivers. We have the actual price performance of the S&P 500, which has clearly been in positive territory of late, with the idea that stocks at times can be sort of forward-looking signals of what's going on in the market, but then also cues from credit spreads, credit conditions, and in the yield curve, which while the S&P 500 stocks are saying, hey, things are okay, some of the signals we're getting from the bond market are a bit more cautionary. And then from the real economy, we're looking at things like new orders for consumer and industrial goods. We're looking at measures of the labor market, leading measures such as hours worked and initial unemployment claims. So less about historical unemployment and instead just focusing on where's the puck going, so to speak. So that's sort of a flavor of what goes into this.
Okay, and we've been hearing a lot about just obviously the different indicators just in the news. I mean, just think about the unemployment, or as being sort of a headline statistic, and also what an inverted yield curve means being another one. But you wanted to highlight an interesting one that probably doesn't come to mind for most people, but can really serve as a good indicator for where things might be going.
Yeah, so if we go to the next chart, I think this is a pretty powerful and I think very straightforward concept. This is looking at rail traffic and specifically the year-to-year change in the number of intermodal rail cars. So intermodal rail cars are those big sort of tractor trailer box looking things that you'll see on trains from time to time, and these are the boxes that can go from the big ocean-going freighters onto trains, and then eventually onto tractor trailers to be delivered to final destination. So this represents about half of the rail traffic in the U.S. So you think about things that you're getting from an Amazon or anywhere else online. Chances are it's spent some time in one of those intermodal cars. And so what is striking is that we are, the growth rate is sharply negative, down about 15% on a year-over-year basis. And this is, I think after we've done a lot of the grandfathering in of the explosion in inventory that happened post the pandemic, as stores rush to restock shelves and everything. So that's really that big surge that you saw in 2021. And it's not surprising that we saw a negative response thereafter. Once stores got the shelves full, we needed less inventory on the way, but that's reaccelerated again to the downside, which suggests certainly, I think a more cautious stance in terms of what companies are thinking in terms of inventory, and again, potentially a leading indicator of some a greater a caution for the economy as people think about what they're ordering. Another, I think, nice organic metric is just looking at job cut announcements. So here we've just looked at the year-over-year growth in job cut announcements up from the Challenger Gray and Christmas, their labor market survey. And after a period of relative calm in 21 and early 22, we've seen a pretty good upswing in the number of job cuts that have been announced on a year-to-year basis. Now, if we updated it for the most recent data point, it's slowed down a bit. But nevertheless, what we see is, I think, some early signs that while the labor market is still very strong, there are areas that are struggling, and it's broadened out from maybe this time last year, where it was some of the tech companies that were aggressively hiring through the pandemic, into more companies, broader representation across sectors. So when we look at things like this, it suggests that while, again, unemployment overall is still at sort of 50-year lows, there are some signals that historically have been leading that would again suggest that perhaps not all is well in the economy. If we go to the next slide here, I think one other example of this idea that while the news is overall good, there are these cracks, as we call them, and now we're looking squarely at the consumer. And what we've got here is the share of consumer loans of varying types that are at least 30 days delinquent. This data that the Fed puts out, and what we've seen of late is our credit cards and auto loans, the sort of light green and darker green lines on the chart here. Those have ticked up by a couple percent here over the past year or so, which again, at a time of ultra low unemployment, at a time now where we're seeing a little bit of even real wage growth, so wages in excess of inflation. There are consumers out there that are having a difficult time making payments, and this is coming at a time where student loans have been in forbearance because of the policies in place for the past 3 years to help folks deal with some of the fallout from the world shutting down around the pandemic. And so you can see, right, not shockingly, student loan delinquencies are basically right on the floor, despite, prior to that running at a 10% or so, 9-10% clip. And, I think the expectations are, as we start to move back towards student loans exiting forbearance and back into repayment, that's likely to put additional stress on the consumers. And while it's not everyone in the market, it's around roughly about 20% of population has student loans. For those folks, we're talking about an payment somewhere in the neighborhood of $150 to $300 a month, depending on how what the repayment schedule looks like. And and things like that. So not a not a trivial amount to be sure, which comes again at a time where we're seeing these cracks emerge.
And Chris, you had shared with me, and I thought this was very interesting, that approximately 1% of those student loans are actually in repayment. So that means 99% aren't. And people likely gave themselves a raise with that extra money that you just mentioned. So they're living off that, and that's a financial planning no-no, especially if you're going to have to start repaying them down the road. So it's a principle that we want to, and that can kind of go across financial planning principles. If you take the max withdrawal you possibly can, you're taking out any options for emergencies that come up or having that extra money that you might need. But talking about rates, what is the Fed going to do? Are they done hiking rates, Chris?
So our outlook for the Fed is really based on taking them at their word in terms of their guidance, which has been a message of concern around inflation, and really not being satisfied until we see inflation sort of back in the the 2% or so range, give or take. And when we think about the Fed's mandates, right, they're controlling, keeping inflation in check, ensuring full employment to the extent possible, and then reasonable borrowing costs for the federal government. Certainly we are at near, maybe past full employment. Borrowing costs will higher is still reasonable by historical standards. So the Fed really has full permission really to focus on getting inflation in check. And while it's come down, right, it's improved, right. We saw a lot of the goods inflation that's rolled over quite sharply, as again we go back to just some of the distortions that the pandemic injected, right. We saw all the shipping snarls and problems with logistics and the supply chain and all that stuff has largely sorted itself out. We see a lot, spend a lot less time being amateur logistics experts these days, but what's remained has been pressure more on the services side of the economy, and a good chunk of that's attributed to wages, and that's what we've got here on this chart. Just looking at the relationship over time between core CPI, which again, if we plot the latest point that just came out, it's turned down a bit more, so that's good news. But put that against wage growth as measured by the Atlanta Fed, and they do some really nice work, trying to get at sort of what the path of sort of the median wage or typical wage growth is in the economy. And what we've seen has been very, very strong wage growth over the past year and a half, and we're at a point where, because the labor market is so tight, we're seeing the early stages of potential, what we call like a wage price spiral. Higher prices lead to workers demanding and getting higher wages, which then crimps profit margins, which leads companies to try and raise prices to preserve those margins, which then cycles back into additional wage pressure and so on. And so this is something we think that the Fed is concerned about. And so to really get inflation in line, our expectation is you probably need to see the labor markets cool. And unfortunately, cooling labor market, while that sort of maybe sounds good in the abstract, hey, this is really hot, it's cooling off, that's good. In real terms, that's going to mean rising unemployment as we look out into the future.
Yeah, and I just wanted to note, with these higher interest rates, it's more expensive to borrow. And that impacts our clients as well. So as we think about them, that's something that also makes an impact. It's their personal, their business. My dog Creasy Bear and I like to walk through our neighborhood, and as we're walking through, the houses that would come on the market, they used to just fly off in a moment, and now I'm seeing them sit a little bit longer. But Chris, what's really interesting is what is this doing to our portfolios?
Sure. So I think when we think about higher rates, right? So on the one hand, that is, it's both the, the cost to borrow, but it's also, right, on the other hand, it is the, the return that you're earning for lending. And so I think one of the benefits that we've seen, or, we've certainly seen much more interest, this year than prior years in whether for certain clients it's short maturity, cash management, things like that, because now there's actually some yield to be earned on fixed income, even in the very short maturity stuff. And so in some ways, when we talk about risk management, some of that is this idea of risk relative to the reward that you're getting. And what we're seeing today is an environment where risk reward is maybe less skewed towards stocks than it's been in some time, and that's what we try to capture here on this chart. And so what we've done, the gray bars represent the range of yields that we've seen over the prior 5 years, looking everything from 3-month treasury bills, T-bonds, 10 years, A-rated investment grade corporates, and then we look at the earnings yield on the S&P 500. So the earnings yield is, think of it as the inverse of PE. So instead of looking at price to earnings, you look at earnings over price. So if you think of earnings as your coupon, loosely, that's how we get to this idea of an earnings yield on the market. And for the past 5 years and for most of history, what you see is this sort of upward sloping relationship where as you either lend money for longer or take on additional credit risk, your yield should go up. You should be compensated for that. We've talked in prior webinars, prior conversations about the idea of the yield curve being inverted, right? So just think of the price of relatively risk-free money, lending to the government from everything from 1 month bills all the way out to 30-year, right? The idea that that curve was inverted, and that's a sign of expectations of slower growth ahead. But what's I think really interesting is if we broaden that out, and what we've charted here, those green dots are where we are today. You could say this represents sort of a risk curve, or what are you earning as we go across these different assets? And that is pretty flat to inverted. So when we think about how portfolios are positioned, why in our portfolios we're generally underweight exposure to risky assets, stocks in particular, as well as credit in many of our fixed income portfolios. This is part of it, where the the compensation that we're getting elsewhere is is not unattractive by historical standards. And again, looking at the market itself, you need to have an expectation of very strong growth, or even further multiple expansion, folks willing to pay more for every dollar of earnings, which actually pushes that earnings yield down lower. So absent those types of expectations, which we don't have at this point, and we don't think are warranted given what we're observing in the economy, some of these other asset classes, other portions of the fixed income market start to look a little more attractive than they have in a while.
So, Chris, that's really good background and kind of an overview of what we're seeing in the economy and kind of where things stand. But can you provide more specifics then on what we're targeting at Manning & Napier and sort of the opportunities we're seeing right now?
Sure. So when I say that we're underweight stocks in our balanced portfolios, underweight risk, that's not to say there aren't opportunities that we're finding. And as a reminder that probably doesn't need stating for many of you that have been with us for many years, that we build our portfolios one stock at a time. We're looking for those investments that satisfy our investment strategies and meet our pricing discipline. So even in an environment like this, we are still finding a decent number of companies that we do want to own, just not so many that our analysts are chomping at the bit to fill portfolios beyond sort of the midpoint of their range and allowable stock exposure. So in terms of things that we're looking at, the first is sort of a repeated mantra that we've had for some time now, which is focusing on what we call our platinum profile. So these are companies that have very strong competitive advantages. These are companies with very massive moats around their business. So we're thinking about things like intellectual property, strong brands, very difficult to switch to a competitor, companies that even in difficult economic environments, while they're likely going to feel the pinch to some degree, they're also in position to weather the storm, whether it's because they're selling essential goods. If we think about consumer staples, or they are companies that are doing unique things where they're able to gain market share at the expense of their competitors. So these are things been a majority of the portfolios where we're finding opportunities. But I think what's more interesting maybe to focus on is the fact that we have seen some areas of the economy get ahead, I think, of the rest of the economy and start to actually price in greater risk of recession, and they've sort of reacted first. And they may very well be given our outlook sort of the canary in the coal mine for the broader economy. But we think looking at areas, housing and railroads, for example, where we've seen enough damage done, enough pain, that we're starting to build positions. And so on the housing side, the focus has been more in the folks that make building materials, or beneficiaries from home construction. There's certainly a very strong case for a structural long-term shortage of housing domestically, and those types of companies we think can benefit both from new build as well as ongoing a renovation of existing homes, as higher rates have trapped many people in their current properties by virtue of the low mortgages that they enjoy. And more recently, railroads. So this one I think ties in very nicely with that chart I had of rail traffic earlier, where as these stocks have reacted to this fall off in volumes, and it's not just the intermodal. We've seen weakness in a lot of the other types of products shipped by rails. This has given us an opportunity to build some initial positions in the rails. And when you think about railroads, yes, they're going to be tied to the end economy, but longer term, these are great businesses. I mean, railroads are virtual monopolies. You talk about barriers to entry, things that are very difficult to replicate, right? Good luck building a competing railroad, a competing set of tracks in any urban area, or anywhere else for that matter. Very expensive, very high fixed costs. So, we think that's an attractive area, an area where, yes, we're going to take on some economic cyclicality, but we think that we have a attractive point to start gaining some exposure today. And then the other one I'd reference is banking, and not because we have a lot of exposure in the portfolios today, but rather this is an area where our analysts are doing their work in advance, as we always seek to do, thinking about, as the cycle unfolds, typically what happens in a classic recession is those delinquency rates that we looked at give way to outright charge-offs and losses having to be taken by banks. And typically, as we see those charge-offs start to surge, the consensus view on these types of banks, sort of in the face of volatility, people panicking, ultimately they start to get priced like the sun might not come up the next day. And so what we're thinking about it really through the lens of a panic strategy, for lack of a better description, looking for an opportunity to buy well-positioned banks at what we think are going to be compelling prices, as and our expectation would be, as the recovery starts to unfold, those some of the provisions, some of the money the banks had set aside for their expected loan losses are going to prove overdone, and there's going to be opportunity to benefit as those provisions are sort of released back into earnings.
Right. Well, I think we talked about keeping a perspective on the long term, and Susan went through different time periods earlier, and just sort of a good illustration. But if we take a close look at the last 5 years, so starting in mid-2018. So the market was chugging along, before COVID. Then we went through a global pandemic that ground everything to a halt in 2020. Markets came charging back in really an unprecedented manner. And then all areas of the market, really struggled in 2022. So This chart here shows that the cumulative returns over that time period, looking at a range of our multiple asset class strategies. And I mean, first off, you can see it's nice to see. It's very positive returns over that 5-year period. Now we're proud really to highlight that the strong relative performance we've been able to generate over that time, as seen in the dark green bars there. So, this is due to really active management, having flexibility, over time we really felt like it was a roller coaster ride, and being able to move into areas of opportunity and managing through areas of risk over that time period.
Yeah, and I just want to add, being underweight during some of this period as well, with virtually no interest rates or very low interest rates, right? And so that was a very interesting time, and to have risk management. And I think this is a testament to Chris and his team and what they were able to do with that. The nice thing is we do now have some interest rates and fixed income, like Chris said, and so we're prepared to move forward. So thank you, Chris and team, for all that you've done to help us.
Next slide here is just this is a look at sort of the annualized performance base that was used, with the numbers that were in that chart. So a different way of looking at it there. So actually, next we'll pull up our next poll question that you can answer. Should be coming up here momentarily. Yeah, and it's I think one that a lot of people will have an answer for, probably. When do you plan to retire? And that's a wide range of options here. I've already retired, less than 5 years, 5 to 10, 10 to 20, or 20 plus. So it'll just be interesting to know kind of where people stand there, and from a retirement standpoint, and thinking about kind of the various areas of planning that goes into those different areas.
Yeah, and I think there's something for everyone in every stage. And we'll talk a little bit about people's financial plans. So the conversations I've been having around that have been a lot of, we want our clients to achieve all the goals and do the things that are most important to them. And the polls come up here, and we kind of have a bit of a barbell. So some people have already, about a third of the people have already retired, a third have about 20 plus years. So this can work for anybody on that, but I'll try to cover as much as I can to take care of all the people that are on the call. And the thing is really looking at what are the things that are most important to you. So if we think of that Venn diagram, right, of here's all of the things that are important, and here's what you can control, let's focus on that area that overlaps. And so what we try to do is, whether you have a financial plan in your head, whether you've gone through this process with us, or whether you're planning to go through this process with us, the more you can articulate those goals, more than just saying, I want to make as much money as possible. Sure, we all want that. But in our heads, we also have, what does that look like for me? So there's those basic needs that we have, those everyday living expenses, healthcare, maybe college for kids or grandkids. We have wants, so the retirement party, or getting a new car every several years. And then we have wishes, and maybe it's a major purchase like an RV here. And we're going to rank those and look at them. And then if you're closer to retirement or in retirement, timing of when we make those purchases and take money out of your portfolio might come much more into play. So we're going to look at what's the best time frame to do that, and make sure you're on track to meet as many of those goals as possible. And then we're going to, after we look through all of these and make sure that we have everything down as much as possible, because the more that we have in this vision, the more we're going to be able to see if we're able to meet all of these needs and wants and wishes that you have. So then we'll run a Monte Carlo scenario to see what that looks like. And that's 1,000 different trials of all the ways that the market might return, all these 1,000 different market type returns. What if we have another 2008 and 2009, since we used that earlier, coming up? And that's what happens right when you're about to retire, or 20 years from now when you're about to retire? Are you going to be on track to meet all these goals that we talked about? And so this is going to show that what I like to call here in Florida, the hurricane spaghetti plot. So there's that top line that you can see. And boy, if that ends up happening and everything's perfect, we're going to have a heck of a fun time planning for you. And then there's those blue lines where the plan fails. And the nice thing about doing this, because we work with our clients to do this over and over throughout time, or as life changes happens, we're going to try to avoid those and make sure that we adjust the plan, because we can do that to make sure that that's not going to happen. We want to stay in that confidence zone that this client's 91%, they're over the confidence zone, which is great. But the likelihood is really in that middle where you see the bunching of the purple lines. That's more likely of where your plan's going to end up. And so we're going to make sure that we work to get you to that and to look at all of those important things that are most important to you and to keep in that confidence zone. And
Susan.
one thing I did want to mention too, is that was showing this particular scenario after the market's gone through challenging times. So I think that's something that I have found for a lot of clients that they feel very comforted by. They look at this and say, wait, yeah, the market doesn't feel good. And I don't like these short-term returns that we were talking about, controlling that mindset earlier. But they go, wait, I can still meet all of my goals. That's what's most important to me. I can still take my family on that trip around the world. And that's what I really want to do.
And Susan, when you're thinking about when you're meeting with your clients and you walk through the big picture, and so, you know, that modeling is extremely helpful for context. But as far as outlining some really some strategic planning ideas and opportunities, particularly right now, maybe what we're seeing with current legislation, you know, can you kind of outline, you know, some of those ideas and some of the things that you're highlighting for clients?
Yeah, absolutely. So I think we can say that 30% of you that are on the call that are, you know, still far away from retirement, you know, savings is super important. So to continue to put money away to dollar cost average, to put money into Roth IRAs that are going to grow tax-free. In fact, my colleague Chelsea, where some of us might have forced putting money into Roths, because in our 401ks, those with people that are high earners, my friend Chelsea my colleague sent me an article about how people that are high earners, their catch-up contributions are going to be forced into the Roth. So that's a planning change as well. If they were, you know, using that to tax defer that money now while they're in a higher income tax bracket than they might be down the road. But there's good things about the Roths too. We just want to plan appropriately for it. And, you know, I want to mention too, this, if you're in retirement or well past this, this can be helpful for the people that you care about, making sure that your values and the good financial planning behaviors that you did to get to where you are, and the success that you've had, that you're passing that legacy down. And we can help with that. So your financial consultant can be a sounding board for your family and friends. We're happy to help them. I've just done that recently with some of my clients' kids and grandkids, and it's really fun. A lot of them have been instilled with these good behaviors, but for them to even go through a financial plan and see some extra steps that they can do to get there has been really helpful. Another thing about savings is the RMD rules have changed, and now in 2023, you don't have to start taking your required minimum distribution until age 73. In 2033, that's going to go out to age 75. So there are a lot of strategies when it comes to that we want to continue to let that growth happen. Some other strategies we want to talk about are tax strategies like the tax loss harvesting, when we can do that. And we were able to do that some last year. So all is not lost in 2022. There's some good things that can come out of those times, and we want to take advantage of them when we have that opportunity. Also, just making sure, like I said, timing those withdrawals can be very important. And I think, Dana, you were going to share some other upcoming things to think about.
Yeah, I think, you know, something that's come up in most of our conversations, I think, when really planning, you know, and thinking out long term, it's the fact that the current Tax Cuts and Jobs Act legislation will sunset at the end of 2025. So I know it's very favorable tax law in the sense that tax rates are lower right now. And there's certain provisions that when they revert back in 2026, there's going to be, it could be a missed opportunity if you don't take advantage of that right now. And so that's something that we're talking to many of our clients about. And I think, that goes into one of the big ones, I think, is estate planning. That's an area where right now the estate tax law is extremely favorable with, for spouses, you've got a combined federal exclusion amount of up to almost 23 million. So that's a lot that you can shelter from estate tax. And what will happen is it'll be cut in half at the end of when this law sunsets. So in 2026, that amount will be cut in half. So that's just an example of, it's still a lot of money, large estates, but it is going to bring more people into the fold when it comes to estate tax. And so right now, an opportunity is to maybe set up some trusts, do some aggressive planning, put some strategies in place now under the current law, because the favorable current law, because the IRS has made clear there will be no clawbacks on any planning done right now under current law. So that's an opportunity right now where, sort of reviewing the estate plan, thinking about those strategies, and talking from a planning standpoint about how you can put some of that in place so you don't miss an opportunity. And I think, also just the ongoing, taking advantage of ongoing gifting annually to family members. That number of 17,000, the annual gift exclusion, it's gone up just this year. So that's something that many people don't, it's not really highly advertised. So it's something that, I think people don't realize, you can do a little bit more than you could last year where it was 16,000, now it's 17,000 per person. And I think there's just other charitable giving options, right, Susan, that, I think are, we talk to our clients who are very, they're philanthropic, they're thinking about, again, with a larger estate potentially, or even they just want to, benefit a good cause, really thinking about what's the best way to do that.
Yeah, absolutely. And I think this is a thing, and there's, like Chris said earlier, there's always two sides to a coin, right? We were talking about interest rates. Here's another place where the higher interest rates are helpful for charitable planning. So charitable remainder trusts, I think I'd alluded to this earlier, they're looking more attractive now. So that's something that we can do, or a qualified personal residence trust. So a lot of people got second homes during the pandemic, and they still want to use them, but then maybe get them out of their estate and have some of that growth come outside of the estate, and have a discount on that gift. Those are things that can be really helpful, especially if that's a special place and everyone in the family's hearts that is intended to stay within the family. So higher interest rates are going to make that much more attractive as well. And then the, qualified charitable distributions, again, this goes with some of the tax planning as well, being able to take money right from your required minimum distribution that you have to have, and not having to pay income tax on that by giving that to a charity that's near and dear to your heart. You can also now use $50,000 of that to fund a charitable remainder trust or a charitable gift annuity. So those are things that are very helpful as well.
Yeah, and I think what's an interesting fact with that is, despite the required minimum distribution being pushed out further, the qualified charitable distribution is still available for people over 70 and a half. So it can be confusing from a planning standpoint, but at least a nice opportunity where, if you do want to benefit a good cause, you have that opportunity to move money out of an IRA and into a charity directly.
Yeah, absolutely. And these things always seem to be changing. So very important that we stay on top of that. And while we're doing our financial planning over the years, to continue to bring up all of these different important topics. We kind of wanted to end before we get to questions on some, last thoughts. And there's a proverb that the best time to plant a tree was 20 years ago. The second best time is today. And I say that kind of as a precursor to this next quote, because, wherever you are in your journey today, whether that's saving for retirement and you're younger and you're saying, hey, I've got a long time, the things that you do for yourself today are going to make a big impact. Or if that's the estate planning that Dana was mentioning, that you're doing for your family and your community, or for whoever's most important to you, those charities that are near and dear to your heart, those things, I love this Warren Buffett quote that someone's sitting in the shade today because someone planted a tree a long time ago. Those things that you take action on today are going to make that huge benefit, and you're going to see some of it, and some of it may last long after your lifetime, but that's really impactful, and that's something fun to see, and just makes us feel very good when we see those plans take flight for the future.
Great. That's a great way to end our prepared portion. Chris and Susan, thank you for your insights. Before we turn to Q&A, we want to highlight that if you have any questions, maybe after the fact or just come to mind later, feel free to reach out to speak with your financial consultant, or if you don't currently work with one, contact us and we'll be sure to have somebody reach out to you. With that, let's get to the live Q&A. We aim to select questions that are as broadly applicable to the audience as possible. Please submit any and all. That's fine, but if your question is not answered, we'll do our best and we'll make sure to have somebody reach out shortly to address it. So looking at the questions that have come in and some that were sent to us ahead of time. I guess this one's probably a good one, Chris, to start with for you. A couple people I think had a question similar to this, but if the economy were declared to be in a recession, what specifically would be different than it has been for the past year or so? I guess probably what's the relevance of even declaring a recession, right?
Right. So I think from our perspective, what ultimately really matters is what happens to earnings, and which is why we remain concerned about the risk of recession today at a time when valuations are quite full to outright expensive in certain corners of the market, and expectations for earnings have actually, while we saw a little bit of a retracement or expectation for a little bit of softness this year, they've actually accelerated now, and we're back towards expecting growth out into the future. And so we're worried about, in a recession, a disappointment to earnings, which at a point where given that market backdrop, we think that there could be some meaningful risk to the downside to stocks broadly, and companies perhaps at the forefront of the downturn. So, but in a recession, I think the main things that we would be looking for is you'd likely see unemployment move higher, and it doesn't have to go back to the 10% or so that we got back during the financial crisis. Certainly not the near 20% that we saw when the onset of COVID there for a couple of months. But we think there's scope for it to go higher. The other things that we would expect, like I mentioned, earnings likely lower. We're going to see inflation fall. Inflation is going to decline as economic activity slows, as pricing pressure demands for goods wanes, as there's slack in the labor market, there's less less money in consumers' pockets as a whole. All those things we would expect to contribute to towards disinflation. And as recession unfolds, we're also going to see we'd expect to see the Fed cut rates. So, these are some of the things that we think about as a recession unfolds. The other thing that we're looking at, and we've talked about these in prior webinars, is we'd expect credit spreads to be wider, right? We expect to see a normal default cycle. We're already seeing rumblings. There are news stories where we're seeing some of the investment companies that specialize in distressed debt investing, so buying the debt of defaulted companies. They're bulking up their loan workout departments, which means they're hiring a bunch of lawyers that specialize in bankruptcy. There's anecdotes like that. So we expect those types of things to happen in a recession. And like I said, while we're seeing cracks or little things on the edges, we're certainly not we're not there yet.
Okay. Next one, that's probably a good one to cover here, is to what degree will the 2024 elections affect market trends, and what action should investors take as a result? So I think a few people asked about that, and I'm sure it'll be more and more on people's minds as we get closer to that time period.
Yeah, I'll take a crack at that one first. The elections are really fun. I know it's always a stressful time, and when we tend to, especially in today's world, so much information is coming at us so fast, and a lot of it not super positive. And so we think this is worse than it's ever been, and all of those types of thoughts that go through our minds. That being said, back in the day, politicians had duels. Luckily, we're not seeing that yet today. But so this has always been contentious, though. That's what I would say. And I think, over the long term, when we look at these different election cycles, if the longer term we look out, sort of like that first graph that we looked at, you're not going to see a lot of difference between the different regimes that are in, right? So there could be short-term bumps. We certainly expect that. And I think, half the population's probably going to be shocked by how the market reacts or doesn't react, as the case may be. But Chris, maybe you can add a little bit more to that as well.
I think that's a great characterization of it. And in terms of when does the market do better, depending on which party controls this or that branch of government. I would say you tell me which party you want to see come out ahead, and that I can show you some numbers that'll make that happen, depending on how far back we look and how you quantify things. Which, again, is just it's a long way of saying it. Over the long run, it doesn't matter. Companies are fantastic at getting the lay of the land, understanding the new rules of the road, and adjusting behavior accordingly. So when we think about it from an investment perspective, generally the opportunities that we see around elections, around geopolitical events, are generally disruptions, or things where you have an outcome and everyone rushes to a good example back heading into the 2016 election, when it was at one point more or less a foregone conclusion amongst all the political pundits that Hillary Clinton was going to win, and it was just a question of how much. And you saw a lot of healthcare companies get sold off pretty hard on that news running into that. And that was an opportunity for us actually to build positions, increase positions in a number of those companies. And it was not in any way a prediction on which way the election was going to go or not go, but rather our investment outlook for those businesses were, these are well-positioned companies. They are providing unique treatments, unique therapeutics, that regardless of whether it was Clinton or Trump that was victorious, there was still a big place for these companies, and it ended up for those companies getting a little bit of an extra tailwind, because maybe the threat of regulation was less, but that was in no way a motivator. It was really taking advantage of the overreaction and looking to invest in companies that we thought were going to benefit, again, regardless of which way the politics went.
Yeah, good. One question was just posed. It basically reads is with 1/3 of participants on the call who are retired, based on the poll, what are the firm's current thoughts about duration and the yield curve? So I think we touched on this a little bit, but it's a good point if people are really thinking about maybe sort of fixed income, and what's the general overview there. What are your thoughts on that, Chris?
Sure. So the story last year was one really of bonds, particularly your longer duration, longer maturity bonds, suffering as yields went higher, as folks reacted to what was inflation that was maybe far more persistent than many had expected back at the outset of 2020. And I think we've moved into a more normalized environment for fixed income, in as much as we've gotten the inflation, we've gotten past the inflation shock, and now as we think about our outlook and how bonds tend to behave in periods of slowing economic activity, you know, we think that it makes sense, you know, for folks where you know, that don't, you know, for one reason or another have immediate cash need, which would, you know, justify some you know, very short duration assets. It makes sense to you know, to have some exposure. Our fixed income team is roughly about sort of market weight in terms of duration, so we're not disproportionately investing in longer maturity, longer duration securities than the broader market, nor exceedingly shorter. Where we are focusing is more on you know, what we describe as sort of the belly of the yield curve. So think of like sort of the you know, 5-year in and around that that vicinity. And what tends to happen in periods of economic distress is, you know, yields broadly across the curve will fall. And what we find is the bang for the buck that you get typically around, you know, in that belly of the curve area tends to be nearly as good as being out longer, 10, 15, 20, but without that duration risk, so less bumps along the way. You know, so that's sort of where we're, you know, how we have things sized up for folks with you know, taxable portfolios. You know, you may notice you know, maybe not as many you know, munis or exposure to munis in there, and you know, that's really you know, just been motivated more by a you know, the fact that you know, pricing there is you know, it has been quite rich. So again, just not getting you know, we don't think getting compensated even on an after-tax basis. You know, and the other thing, I was just on a call with Mark Bushal, who runs our fixed income team earlier today, and he reminded me of something that they've been focused on, and that's the idea that, you know, when you own municipal bonds, you're getting, there's credit risk inside of that, right? There is you know, the global financial crisis. It was a pretty good you know, reminder to everyone that you know, munis are not you know, not risk free, and there is some credit risk. And what tends to happen when we you go into a downturn, state and local tax receipts get pressured. And so while, you know, we're not expecting a wave of muni defaults, if the risk increases marginally, then those spreads will increase. So over time, we'd love to own more munis for our taxable clients, but just waiting for you know, waiting for the right time to do that.
Yeah, and we've come up to an hour here. We'll stay on and answer a few more questions, but just you know, obviously, if you don't stay on and don't have a chance to answer your question, like I said, we'll make sure that we follow up to answer your question for you. So you know, another one that I think is good to cover, that this one just was posted as well, and Susan, may be good to get your thoughts on it, but it's just is the 4% withdrawal, I guess, withdrawal target still sound for somebody investing or living off of their money?
That's a great question, right? I think that it's a rule of thumb for a reason, but it also really depends on the situation. And it's something I talk with clients quite a bit, and I know all my colleagues do as well. So it really depends on your situation and what you're trying to accomplish. Are you trying to, you know, leave money for a legacy? Are you trying to maximize as much as you can spend now? And there's always levers that we can pull, and what's most important to you. So I think it's worth more of a conversation than just saying a blatant, yes, that's fine. I think it could be higher than that. Actually, it's just going to depend on each person's specific situation. And Chris and Dana, feel free to add as well.
Yeah, no, I think it's interesting. There's you know, you always see stories about, you know, kind of questioning rules of thumb, and the 4% one, you know, being one. I think, yeah, obviously it's as you have higher rates, that certainly helps to take the burden off of the equities in your portfolio to generate that return for you. So I mean, that, you know, that in the current environment, that certainly is highlights that there may be, you know, in some ways that's more feasible than maybe it felt over just a couple of years ago. You know, I think there's another one that you hear about right now, or at least it was popping up a lot, was sort of the 60-40 stock bond mix that, you know, is very you know, was used as a good general balance for long-term investing. You know, is that now kind of flip-flopped to 40-60, you know, and that because of where rates have moved up higher. And so, you know, a similar sort of challenge to the fact that I think it still goes back to it's probably not outdated. It's just a matter of, I think you bring a good point up, Susan, where it's important to have a perspective as far as, what your plan is and your own personal situation, and really not getting caught up in just what's a general target rule of thumb, but let's actually take a look at your personal situation and really tailor something for it.
Well, and I think that's where our planning tool can really help as well. And even looking at those timing of distributions can make a huge impact on that long-term plan.
Yeah. And we'll do one more here. I think Chris, now let's cover the one on, somebody had a question about sort of energy and, just general outlook there and what we're seeing. So if you could speak to that.
Sure, certainly. So when we think about energy, and particularly with the aim of when are we invested in it, when aren't we invested in it, our framework there views energy as a cyclical industry, such that we want to be investing when there are there's clear signs of pain in the industry, and looking for that pain to bring sort of rationalization. So bring take out excess supply, and be able to invest in those companies that we think are well positioned to come out the other side. So if with that as sort of the conditions where we get excited and want to invest, we're in an environment today where it's really sort of a no man's land vis-a-vis that strategy, where really supply and demand are pretty reasonably balanced, which is pretty good news if you're an oil exec, bad news if you're us looking for opportunities to buy. Like we can go through and for every potential thing that could be contributing to higher prices, or for example, like the risk of the cuts to Russian oil supply, right? That hasn't really materialized anywhere near as much as folks thought, or the extent to which where you get excessive demand as China reopened. No, not so much. That's disappointed. And we can go through one by one, and for every potential positive or negative, we're finding offsets. So really for the moment, we are we're largely out of energy in the portfolios, and really looking for a something that we think could tip the industry into oversupply. And again, I think this gets back to the recession idea, right? One of the things that we've been talking about across the research teams, alluded to it when we talked about the banks earlier, is what do we want to buy when the time comes? And so we would expect in a recession, typically what happens, demand for energy goes down as the world's making less stuff, going fewer places, and that could potentially give us an opportunity to build exposure there. So it's, like I said, not a bad time if you're an energy company, but given our framework, where again we really want to invest at those points in the cycle where there's signs of pain, and we think it's a fairly asymmetric bet to the upside from a positioning perspective. We're just not there yet.
Okay. All right. Well, we've come to the end of the time that we have for today. Thanks again, Chris and Susan. And I want to thank everyone also for taking the time out of their day to be here with us. We'd greatly appreciate it if you can take a few seconds to fill out the survey that we've linked into the chat section, so that we can have some feedback on the webinar today. And we also invite you to register for our third quarter market update webinar. It's taking place on October 26th. The screen says the 24th, is actually the 26th. So we'll be back to share our views and where our outlook stands for, after we make our way through the next 3 months. Please register for the content that Manning & Napier creates, covering a broad range of planning and investment related topics. Produce a lot of really a significant amount of really good material that I think addresses good topics that you may find interesting and helpful. And also, if you're interested in learning more about Manning & Napier, please visit the link that you see on the screen there to schedule a call. So on behalf of my colleagues, Chris and Susan, Manning & Napier, thank you again and have a great day.
Thank you. Bye-bye.